Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Hunter Walk, co-founder of Homebrew and Screendoor. Hunter's had a fascinating career, ranging from working on Late Night with Conan O'Brien to running consumer product at YouTube to his journeys at Homebrew and Screendoor. Homebrew's hits over the years include Chime, Plaid, Gusto, Cruise, and more. We talked about trust and context, product, funnel math, and why Hunter isn't as fussy about valuation as he used to be. I hope you enjoy. And we've picked up a lot of listeners recently, which is awesome. It's great to have you here. If you're enjoying the show, if you could leave us a 5-star review, I'll shamelessly ask for that on your preferred podcast platform. It does help. And with that, thanks, and let's listen to Hunter. Hunter, thanks for coming on the show.
Oh, absolutely. Thank you so much for having me. When our mutual friend Charles Hudson suggested that you're, great on the other end of a podcast mic, I was like, well, introduce me and let me talk to him.
Cool. Well, that's high praise, and I appreciate that from Charles, and it's great to have you here. I've read a lot of your stuff over the years, and should be a fun conversation.
Yeah.
I'd imagine a lot of folks are familiar with you, but I thought a good place to start would be to talk about Homebrew and how it started as a traditional LP-backed firm, pivoted eventually to an evergreen model with Homebrew Forever, which was so fun. I love the name. But maybe start with walk back to the decision from moving to being LP-led to essentially you and your partner, and maybe how that journey has gone since then.
For sure. So yeah, thanks so much for sort of helping me walk through this. Yeah. So we started Homebrew in late 2012, early 2013, raised 3 funds from outside investors, sort of classic institutional LPs, endowments, foundations, people we loved being in business with, a relatively small group. And then in 2022, versus raising a traditional 4th fund, switched to a fund 4 that was, sort of self-funded, so to speak, which is why we call it Forever, because number 4 plus ever, it's our evergreen model. Makes me smile every time I think about it. So, the question is, if we did that in 2022 and started in 2012, when did it occur to us that we wanted to do something like this? And I'd actually say in 2012, which if you talk to our LPs from the earliest days, when we were raising the first fund, we said, hey, look, here's the way we're thinking about this. We're small business owners, so we can revisit this decision at any point. But we're starting out with the assumption that we're going to do kind of 5 funds, 20 years, and then switch to a personal capital model. And, not to give ourselves sort of, have earned the right to do 5 funds, but we hope, we're successful enough to do that and then make the switch. But so you don't have to worry about us like going anywhere anytime soon, but you also don't expect us to be a multi-generational, multi-decade, large venture fund. That's not what we're trying to build. And we want to build sort of a very specific version of Homebrew. As you sort of noted, it's not yet 2030. So if we thought we wanted to do this model, but had anticipated not doing it for, another 5 years from now, 2025, and actually did in 2022, like what went right or what went wrong, I guess. And I'd sort of say it was a mix of that. It was 100% what we always planned to do. The timing of it was probably, let's call it like 20% proactive and 80% reactive. So the 20% proactive was, what are we waiting for? Do we feel like we need some more reps, being a lead investor? Is there something else we're trying to accomplish? Or is it just, sort of the mechanics of having the capital to go and start risking it? We should earn some more money. Earning more money would always be nice, but we decided that maybe we're a little bit more risk-seeking than the average VC, and that if we could pay our mortgage, then we could also, do this. And so decided to not raise, sort of the additional funds, because let's just go and do what we always want to do now. But the 80% that I think was a little more reactive were due to kind of changes in the market and a belief that the business model of venture for us, the way we wanted to practice it, started to get in the way of the work as opposed to enabling the work, which was to say, as all of our friends' funds kept getting larger and larger, we didn't want to become another $200 million, $250 million, $300 million seed fund. We felt like that for us would be kind of no man's land, where we were losing some of our differentiation by bringing on the same types of investment teams and operations team that everybody else has, leading the same types of rounds. And maybe even more importantly, we felt like it would distract us from what we really love doing, which is spending time with founders by putting more money and more team in between us and the founders. And also, and this is a little more subtle, although we all are seeking the same types of, outlier companies, I really believe that at the earliest stages, you have to have sort of patience and time to help them figure out who they are and what they're going to become. And if, as the famous quote goes, your strategy is your fund model, the bigger your fund model gets, the more narrow your definition of success as an investor becomes, which I think forces all types of behaviors and mechanics and is felt by entrepreneurs in ways that sometimes can be premature. And sometimes I'd say cause venture firms to put toddlers in adult clothing, thinking it's going to make them grow faster. Whereas we're more interested in like helping the founders become the best versions of themselves than forcing them onto a specific growth curve for the right, markups and the right, I need to get more money into this company and all that type of stuff. So that was the decision. It was an experiment for a few years. And then it sort of became, hey, I think this is the right thing to do. This is what we're going to be doing from now on.
And how have you found your approach has changed from just running your own money, but with fund scale versus having
Absolutely.
LPs?
Well, what I'll tell you is some people think that it was the, your money versus LP money that maybe makes like some big difference. And actually, I don't think it is. I think the bigger difference for us is we also kind of ripped up our portfolio model, which was previously, hey, let's make about 10 to 12 investments a year. We'll co-lead seed rounds, put in, 1 to 3 million of your first 0 to 5, and thus have like sort of a concentrated ownership target between 10 and 15%. And that when we started, that wasn't unique, but it was a little bit more scarce. The number of folks who had both the capital and credibility to focus only on seed and lead seed rounds, I think was smaller back then. And so we felt like pairing the capital with sort of the sweat and reputation was a package that the entrepreneurs wanted. And now that's sort of been unbundled. Like you can put rounds together in lots of different ways. And we sort of felt that like having these ownership targets at the earliest stages were more about the VCs than the founders. Because what it essentially caused the founders to do was it created artificial scarcity in the sense that if as a firm, I need 8%, 10%, 12%, 15%, 20% to make my business model work, those are percentage points that either I can't give to somebody else who's going to be useful in my company, or if I'm going to, I have to take, more dilution or change my terms to accommodate it, so on and so forth. And so the bigger difference for us was saying, look, we're going to commit to the round and we'll give you a range that we want to do, or we'll give you a number, and that number should fit well into however you want to arrange this around. We can still lead rounds. We can still, sort of punch above our weight. But on average, we're making about 15 investments a year now, mostly at seed or pre-seed, mostly between $100,000 and $500,000. And like I said, we go larger in or later. And that's the bigger change, than sort of where the money comes from or that type of thing. Because what that allows us to do, I think, is be very aligned with our co-investors who we are sort of, great partners to and not as competitive maybe as before. And importantly, and what matters most to us, be somebody that if a founder wants to work with us and we want to work with them, there's really no reason we can't. Because if I can't convince you that like minimally that allocation is, we're worth that, then I probably shouldn't even be in this business, right? Like the amount of work we do, I think the ability for us to help is like superior to sort of that small check size. And I guess it's, at least that's proven true. I think, every offer we've made, to a founder has been accepted. Sometimes even a co-investor has made room for us by cutting back their allocation. So TBD, whether that also results in, sort of ultimately investment success, although I think it's trending nicely. But what I do think it speaks to is, sort of product market fit. Let's talk about it from what we're offering to entrepreneurs.
Yeah, for sure. Well, I think it's something you have to earn your way into, right? Which of course you've done. I think somebody stepping in who wants to accomplish all that and have such a wide mandate and build a brand with founders, like you have to earn your way into it. And
that's the thing. It's not that like that's a rare check size. There's plenty of people who will write checks, from funds, from whatever for that. I think it's sort of the value prop of kind of the alignment and flexibility of, sort of an angel with the gravitas experience and network of, sort of what we've built up over the years, pre-homebrew and through homebrew. And so I think that's sort of the more kind of special piece on the chessboard, so to speak. And it's been great. It hasn't really changed what we invest in. We're still very heavy towards like B2B dev tools that of course now are kind of like, AI, CV, ML forward. We still focus a lot on fintech. I think the area that we probably have stretched a little bit into might be domains where before we couldn't credibly assert that we were a great lead investor, like cybersecurity or some deep tech stuff. Whereas I feel like on lines 2 through 10 on the cap table, alongside maybe somebody who's a little bit more of a specialist, we certainly know how to help those founders build a great company. Whereas before, maybe if you were pitching me your cybersecurity company at seed, maybe it's almost adverse. Like, why am I so lucky? I know lots of great cybersecurity investors. You should be talking to them. Now, we can be sort of both like the vertical specialist and or the generalist. And so that allows us to participate in things that maybe don't fit in, sort of exactly the thematic white picket fence, but, we can still make room in the house for.
I'm sure it varies founder by founder, but can you dig into how you like to actually work with founders, what those relationships look like day to day?
Oh, sure. Look, I think that there's really two things you need to have a successful relationship with a founder, and it's trust and context. If they don't trust you to be vulnerable, to share information, we know we're cap tables on org charts, so we never expect, to be sitting there by their side day by day. They don't want us. That's not what they're signing up for. But if they can't come to you and talk about what's on their mind, if they can't work through, ask questions, if they are always managing you and managing what you think of them, I just don't think you're ever going to be able to be that useful to them, or at least you're not going to build the authenticity in a relationship. And then context. Context is, so, hey, we just closed our A round. We're about to start hiring. What advice do you have? Well, there's a version of that that's like, let me send you a blog post somebody once wrote about hiring. But that's discoverable on their own. Answering that question for them means you have the context for, what they're building, where they are, what their strengths are, where they need to fill in around that, the type of culture they're building, what the first 10 people on their team, look like, how they work together. And in those cases, certainly when we were a lead investor, you get kind of like the reps and you have the structural relationship to stay closer on context. I think now when we're more often playing a supporting investor role, we sort of have to work in different ways to maintain both of those things. And so we essentially offer up to all of our founders a version of what we did when we were leading rounds, which is what I call sort of like trees and the forest. The forest is calendared one-on-ones that happen at, sort of a mutually agreed upon cadence. It's not us checking up on them. It's, hey, let's not let weeks, months, whatever go by before we've had the chance to get out of the day-to-day and say, how are things going? What's the arc? Where are you getting, take a breath and talk a little bit about what you've learned, what you need to learn next about this company, that type of stuff. But we all know that startups don't operate at pre-scheduled cadences. And so the trees, hey, we need an introduction. Hey, can you help us close, an engineer we want to hire? We need to talk to somebody about pricing, advice. Are you an expert here, or who's the person to talk to? Like that stuff comes up day to day. And so in those cases, the founders, whether it's a group chat with all their investors or something that they've, done with just a few of them or just us, we are, sort of interacting with them almost on a daily basis, especially around product launches, fundraising events, important hires, that type of thing. And so that's the forest, that's the trees. The way that Satya and I have always thought about it is the partnership matters the most. If he and I aren't, having a good, functional, enjoyable relationship, nothing else matters. We'll, clear our schedule to solve that. Then it's, partnership, and then it's portfolio. There's never a deal hot enough to cause us to neglect a founder that we've already backed, committed to, and who's working through something critical. I will say no to a new meeting all the time in order to make sure that we're doing what we said to do. Of course, it doesn't mean that things don't sometimes move around, there's adjustments, but it's really at the end of the day, I never want to dishonor the commitment that we've made to a founder. And then everything else I focus on is meeting new people, right? That's why, as I said earlier, networking, conferences, flying around the world to raise larger and larger funds from, foreign governments or something, to me, those are all distractions. They're not why I'm doing venture capital. And so we were going to hit that model scales only to certain degrees. And we were definitely going to hit capacity issues if we stayed on the institutional path that we would have had to solve for. But right now, I love my work and I can, serve / overserve any founder who's in a moment of need where we can be a unique voice. So that's how we think about it. We're generalists. I think there's 3 things that generally, matter at these stages, product, go-to-market, and team. And we can sort of help give you advice or clear roadblocks, on any of those. So what was I doing before this? We have a founder who we participate in their pre-seed that's raising their seed round right now. So I was on a call with him with his two other lead investors. I just did a call with one of the investors who's getting close to offering a term sheet on this round, and then shot a note to another person who is in sort of that preferred group that to give her the heads up that like, hey, I think we're going to be in a position to make a, so there's certain things where like, I have asymmetric, sort of like advantage or role versus like, let me look at your PRD and give you some product feedback. But that's what we try to do. We try to be like Swiss Army knife for these founders.
You wrote a piece recently titled "Why I No Longer Care About Startup Valuation When I
Oh,
Invest,
yeah.
Except for These 4 Reasons." It's very literal, so you can probably guess where I'm going with the question, but can you walk us through why you became so flexible relative to where you were on valuation?
And like, it's definitely, obviously, as the cheeky title suggests, like, I'm not in the camp of price doesn't matter, in the sense of, I think actually when you're managing a fund, pricing does matter. On any one deal, ownership matters, but over the course of a fund, pricing matters because you're sort of deciding how many companies are going to be a fund, how many shots on goal you want. So when we were managing a portfolio and managing a fund in a different way, we had to think about pricing as just that. How many companies do we want in this fund? And is, in this company, if we're getting our desired ownership, is it worth 1 company slot or 2 company slots? Are we willing to invest in fewer companies this fund in order to have this one included? Now that we don't have we have a more open-ended structure, we don't do, even though we're shooting for the same aggregate returns, the same failure rates, the same success rates, the same power laws, we think about it a little bit differently. We think of more of opportunity cost, right? Is there upside from here that's equal to somewhere else we could put our dollars? And that's all, lick a finger, stick in the wind at seed and pre-seed. It has probably less to do with, the traction of the company, the early customers, and much more to do with the founders and the initial sort of, financing of the company that impacts that. If it's too small to be quote unquote, venture scale company, it doesn't matter. Like, that's not pricing issue. That's we don't believe this problem is large enough, urgent enough, and valuable enough. Like, we'll say no to that, outside of terms. But if we believe there's a venture scale problem to be solved, there's really 3 things that I think a financing tells us. And, they're more qualitative than quantitative in some ways. First is, very often it's one of the most concrete initial examples of how a founder will make a decision and what they're optimizing for. So I think it just gives you insight into how they're thinking about their company, and given trade-offs, given decisions, what questions do they ask themselves? How structured or vibes-based is their thinking? All that. How do they run a process? All that type of stuff. The second is from a participants on the cap table perspective. Did the process end up giving them the best possible investors, or did they run an auction or run sort of process which they were left with either people who we don't think are necessarily the best qualified for the round, or otherwise sort of get what they paid for, type of thing. Life is too short for us to sort of co-invest with people who we don't believe are of similar values, ethics, long-term orientation, sort of founder forward, thinking. And then the third is it's a mile marker that signals like what they need to achieve in order to get the multiple to the next round that, an investor would want to see, that creates sort of standardization. So essentially, like, are they priced to perfection? How hard or easy is it going to be for them to raise their next round at a 3 to 5x valuation from this one if they do with this capital what they think is possible? If they're priced to perfection, then I'm essentially paying the cost and taking the risk, especially in our model where, we don't hold reserves. We're not a fund per se. So I'm not sort of looking at it and saying, well, you know what, if the next round sort of ends up not being a great round because they didn't get where they needed to, but I still believe in that, that's a buying opportunity for me because I'll pile more money into the company and I'll bring down my dollar cost. Like, I essentially, even though I'm buying preferred shares, I think of it as I am only going to make money if the founders and the team make money. Because over time in a success scenario, we'll probably look more like common in the sense of, unlike some of these large multi-stage firms, I'm not trying to get $5 million, $10 million, $25 million, $50 million into the company. I'm writing an initial check. Most of the time, that's our only check. And I'm looking for an outcome that rewards those people who bet on it early, not just those who are able to take advantage of different moments in time to structure different capital infusions. And so I don't care about pricing except what it tells me about the founders, what it tells me about the cap table, and what it tells me about the next round. So in some ways, I care intensely about it, just not in the same way I did prior.
You mentioned failure rates earlier. Do you have a target, and how did you come up with the number?
I don't have a target per se. I know people have sort of thrown around like, hey, if X percent is sort of traditional. What I think is that over particular vintages and particular sectors, it can be deceiving. And in fact, like, I think we as a fund were hurt by a high survivorship rate in the 2015 to 2020 time period where everyone got the benefit of the doubt. A rounds were getting done with, little information, or there was a lot of people trying to put money to work. And so, it wasn't just the upper quartile of companies in our portfolio that raised A's and B's. It was maybe the, 50th to 75th percentile. And then you have decisions about either for, nominal support or because, you're trying to maintain ownership and you're throwing money into things where like maybe that money would have been better reserved for a different type of company. So, I think about failure rate, not just as an indication of, well, if you don't have a high failure rate, you're not taking enough risk, but also of less about absolute failure rate and more about participation rate. So in some cases, it can be fine for companies to sort of have kick save, bridges, kick save A's. But if you don't believe in that company, don't participate. Better let that actual company find a home or to take the dilution than it is to sort of throw money into it just for preserving a mark to be able to tell the LPs that, the company is still worth what you're holding it at, or blindly assume that like, oh, you need to be a friend to the industry, like always show up, so you have to signal strength by always following on in your companies. Like you shouldn't surprise founders, you shouldn't surprise co-investors, but I don't think you need to blindly follow on pro rata, especially as a smaller fund. So what I do think about sometimes and what I do believe is like that if you haven't passed on companies that later turn out to be very successful, then you're probably not investing in any either. That essentially like you either are or aren't in that type of deal flow, and you are or aren't like, have a framework for making those decisions. And so I almost get more worried when if I ask a fund manager and I say, well, what billion-dollar companies have you passed on? And they say none. And I said, well, do you have any billion-dollar companies that you did, type of thing? Like in the sense of, if it's not failure rate, it should be like, you should really look and say, I believe I am investing in the top, whatever, 5%, 10% of startups that are formed each year. And within that, I'm going to make increasingly good decisions about which ones I back and then which ones I'm able to continue to support. But if you have an arbitrary survivorship number that's more based upon vintage than sort of your own frameworks for decision and your own understanding of startup quality, then I think when the tide comes in or out, you're very subject to the motion of those waves rather than knowing how to like navigate no matter what the weather conditions, so to speak. Look at that.
Well,
I don't even sail and I'm making nautical metaphors. I apologize.
I don't know anything about sailing, so I just totally take it at face value. You'd be completely
and then
wrong,
you're looking at the stars and you have a compass and I'm asking my first mate. I'm going to just keep piling on and it doesn't mean anything. But no, that's how I think about it. So we are perfectly willing to take, sort of swings where it's a question of like, this is either going to work or not work, and we'll know at some point.
I'm a solo GP, so I'm pretty tight with my time, ruthless on prioritization. And something I've spent a lot of time thinking about and I don't have a great answer on is an optimal number of meetings I should be doing for the number of deals that I do. And I'm curious if you have a take on how to approach that, or a framework on how to think about that model.
Yeah. So especially moving into sort of this new model where we could have like are everybody's friend, I knew that we could fill a multiple of 24-hour days every week, fill a 24-hour day many times over with first meetings. And I guess we do some like, maybe a kind of a little bit of like bottom up, like budgeting as, zero, which is to say, how much time do we have that's not allocated to our own work and the founders we back? And then that becomes the capacity. And then that gets filled based upon what level of interest do we have in the problem they're solving? What relationship do we have or not have with the founders already, and or their co-investors, our potential co-investors, and where in their process are they? So I rather eliminate the number of, oh, I should probably just see this to say I saw it or at least come to an opinion if I feel like it's going to not be a high likelihood of converting for me. I'm catching it and it's moving at a pace that probably doesn't make sense, not just based upon absolute terms, based on other things I'm prioritizing. And so for us, kind of like when we were an institutional fund, we had certain verticals and certain areas that we were like, we want to see everything that fits this definition. And doesn't mean we're going to take a meeting with everything, but we want to get close to 100% coverage as possible. And then we think we have a prepared mind for what we're going to be looking at. And then things that were a little bit more adjacent to that, we allocated like a little bit more time per deal because we figured we were going to have to do more work or free ride on other people's work just from a pattern matching perspective and stuff. But ultimately, like our bottom of the funnel, was sort of like back one of every 100 startups that came in type of thing. And we'd probably end up taking a first meeting with 20 of them and a second meeting with like 2 or 3 of them, maybe. So I was always worried mostly about like the quality of top of funnel. And, one of the things I used to say was like, if I'm looking for needles in haystacks, we are not going to have the size team to jump into every haystack. So I need to create magnets. Like, how do I pull the right needles towards us? And, that was founder references. That was Twitter and writing. That was other things that I thought made us kind of like tangible and approachable and would help people self-select whether they thought we were a good investor for them or not. And like I said, I think we were sort of squeezed on that in the sort of second half of our third fund. And probably some of the approaches we took would not have worked for our fourth fund if we had stayed traditional and would have had to solve that. I think fortunately there's some technologies today that help in some of that parsing and data gathering. I don't mean like, automated rejection letters and stuff like that, although I guess you could do that too. But just in terms of being able to keep tabs on people, data points, sort of more easily, we probably would have had to expand the investment team a little bit. Not so much to do like first meetings, get through her or him and then you meet me, but just to be able to move faster on points of view, as well as sort of the servicing side of companies in the portfolio to sort of free up some of our time. But I guess that, I'd have to go back and check specifically, but I think it was sort of like that, for every 100 companies that come in, we, meet with 1 in every 5, and then 1, 2, or 3 of those, we take to a second meeting, and then like, 1 of those we invest in. And that's how we used to get to sort of like about 10 to 12 a year.
Well, that's helpful. My second meeting rate, I went back and looked, and it's 25%, which feels too high. I think it may be that I just have this bias towards looking for a reason to say yes.
Yeah.
And while generally I think that's a good attribute if you're a venture capitalist,
I think to some extent
probably need to be dialed back. So.
I mean, it could be a signal that your, quote unquote, your deal flow is getting better, right? So like if you're looking at really great stuff in general, there's fewer reasons to sort of turn something down pre-meeting or after a first meeting. You're going to be intrigued by something. You're going to want to dig in more. And so I think it is a little bit of like ruthless prioritization about, given the types of companies that you enjoy investing in most, which ones do you bring forward and prioritize? But like nobody is perfect. Like I can only tell you in hindsight what a great startup looks like. And so you have to be comfortable applying frameworks that cause you to sometimes make good decisions with the wrong outcomes, right? So like know when you're making exceptions, but if it's working, like don't break your entire system just because you passed on one good company if you're consistently investing in many more of those same good companies. Satya and I would always debate, like, it's interesting. You look at some of what we talk about as our regretted false negatives, and I think there's some overlap, but I think bias away from outcome of those companies and a little bit more towards that felt like a homebrew company and we talked ourselves out of it, even if it wasn't, a category killing exit type of thing. Whereas I think he's a little bit more willing to say, no, like we were right. It wasn't that successful. Even if we can't exactly identify in a, sort of where did it fit into the framework, like we were right to pass. And I'm like, no, we should have invested even though it wasn't successful, type of thing. So we go back and forth about that a little bit.
You mentioned in an interview back in 2015, a while ago, trying to separate your personal and professional lives as far as your like online, offline personas. And you may have talked about this publicly since then, but I get the impression you still operate that way. but I'm curious how your views on that might have changed over time.
Yeah. Well, my emphasis on that is first and foremost linked to the idea that I'm a believer that I do my best work when I'm working on things that I want on my tombstone, where they are representative of who I am as a person, and they're not inherently a compromise because it's a good job or a means to an end. The question about, or maybe misinterpretation of that to be like, bring your whole self to work or so on and so forth, I think is a individual decision, and you can decide how you want to act in different environments of your life. I'm certainly, I'm the same person with my daughter that I am with founders, but I don't treat my founders in a paternalistic way, type of thing. And so obviously each relationship sort of have its reference points. And so I still very much believe that. I think for some people, and it's why I think we're attracted to, sort of what I'd call sort of more mission-driven founders or founders with high founder market fit, people who've been thinking about things that they're very comfortable saying, this matters to me in an intensely personal way, not just I want to build a great company and I think this is, an area that's right for disruption. It doesn't mean that the whole founding team needs to think that way. It doesn't mean that, it's a quote unquote like do good or business. Like people are attracted to things that matter for all different types of reasons. But I believe that. Now, in terms of how tangible am I, I'm less accessible these days since I got off Twitter a few years ago. And so there's probably fewer people who don't know me, or maybe even people who know me lightly, probably have fewer touch points to sort of keep up with me, understand where I am in the moment. But that's a trade-off I've made based upon like what I think is like healthy for me and healthy for the way I want to live my life, more so than like any particular reaction to the vibes, culture, or politics of our ecosystem right now.
I want to take it back to investing and take it to product in particular, because that
Sure.
feels like your sweet spot.
I'm proud of Homebrew and proud to have spent now more years on cap tables and org charts, but I will always be sort of a product manager at heart.
Do you have any core beliefs about product that are timeless, that flow into how you invest?
Oh, well, it's interesting, the connection that flow into how I invest. I guess I'd say that companies are products. And so you can't just make a bunch of single point decisions and throw them together and say you have a company, right? So your hiring practices, your comp practices, your engineering style and cadence, like all these things actually need to work together. And if there's certain decisions there that matter more to you, you need to recognize that those decisions increase, decrease, or change the, sort of decision set for subsequent decisions, right? Like if you're going to say, I am going to have a culture of, not necessarily hiring for experience, but hiring for slope. Well, then, okay, great. How do you set people up for success versus, just throwing them out there and letting Darwin figure it out? I think you can, but I also think people with high slope early in their careers, there's sets of resources and other things you can make available to them that don't change the nature of the experiment, but actually like increase the number of successful outcomes. And that's like both consistent and beneficial. How do you compensate people fairly once they start to reveal themselves as incredibly high performers? You can have a flat compensation structure, but then, potentially you lose people who start to distance themselves and get other opportunities and things like that. So you have to think through these things and how they work together. So I think probably as it relates to investing, it's, your company is a product would be sort of my mindset. Most of the time we say things like, oh, good culture, bad culture, things like that. I think most of the time people mean that like, that's a culture I'm attracted to, or that's a culture I'm not attracted to. The, only cultures that are truly bad, I think, are ones that are kind of like, well, I mean, if they sort of tread on illegality, but like other than that are ones that are like inconsistent, unclear, or otherwise, sort of contradictory. They say one thing and they deliver another. Like those are not good. You need to fix those. But otherwise, there's any variety of like wonderful cultures, dynamics, compensation structures that like companies can succeed by implementing. And then like a variety is good. People should be able to choose from, I want to work remote, I want to work hybrid, I want to work in office. Like I have my own opinions about like, at different phases of startups, what makes it harder or easier, but like marketplace of ideas, let people decide what kind of like cultures and styles and types of companies they want to work at, and then, create the best version of it.
We've been talking mostly through the lenses of early stage investing, but you do plenty of investing into emerging managers yourself, and maybe could speak to Screendoor and they could lead into that. But that question there of your company as a product. How does that conversation go when you're talking to emerging managers and VCs?
Yeah, 1,000%. I mean, your firm is a product. Like, I think when people ask us, oh, what did you do in fund one that if you knew now you would have changed? I'm like, nothing, because we were actually quite deliberate and quite thoughtful. I mean, obviously there's sort of like execution things that you've been like, oh, I would have done this. Or by the second fund, I realized that, we had the opportunity to do a little bit more of Y. And so we got more confidence. But it's like, I think we're very thoughtful about how we believed our check size, competency, fund size, LP base, temperament kind of all work together. And then, and did the market need that at the time? And so when we're Screendoor, which is a fund of funds that Satya and I and others helped create a few years ago and now has an amazing full-time team and helps to anchor new venture funds. The way I would say is they're looking for, like, we back diamonds and diamonds in the rough, I sort of say. People who are sometimes spinning out of big firms who like have some experience under their belt, but probably haven't run a firm before. It's their own thing. Or people who might be even earlier in their investing career, but have excellence or capacity for excellence and are sort of, moving full-time into investing. And then when I look at those, independent of them, I say, okay, they have to be different and excellent or similar, but better, right? So like, are they coming with a different approach, doing something that is, if not unique, additive to the ecosystem? And can they do that well? And if they're running a model that looks more like a homebrew or whatever, somebody who's already out there, is there a reason they're going to be better than me? Like, is there a reason why yet another early stage generalist fund is going to be that interesting in the ecosystem? And fortunately, a lot of them have answers. And I think most of those answers come down to strong points of view that are informed by their identities, experiences, and networks, and having been so close to the iron, as opposed to some of us who've now been in the field for a decade or more. And so I don't think we've backed any firms where I'd say the fund one is not a pretty thoughtful representation of what the managing partner, the GPs, believe to be true about the world. The question is the fidelity of that, and can you update that, evolve it over time? The gravitational pull of venture causes all these firms, if you're successful, to get bigger, bigger, bigger and hire more people. And so do you end up diluting that? Do you lose that edge? And it just becomes more of, sort of we exist to back the brightest and smartest people, building world-changing companies. Like, okay, great. That means nothing. And so the uniqueness of the founding moment, can you create a firm that spans multiple generations, spans multiple fund cycles, grows beyond its initial people, and still has that, fidelity, or includes the fidelity of other people who come in, or does like the growth in AUM and growth in team size not sharpen those insights, but dull them?
What's a conventional view in venture you think is BS?
Oh, maybe related to that, I don't think most venture firms should be multi-generational. So I'm an old guy, right? So I'm going to use another metaphor. This isn't the sailing metaphor. But like when I was growing up, you had like cassette tapes or VCR tapes. I mean, I also had CDs and stuff, but I was old enough that like
we
that
had
was
a beta at home.
Yeah. So that was my first generation. And you'd get like for some things, you'd go to the video store and get the new releases. But like, the bootleg of the concert or the mixtape that was really good, you get the dub of the dub of the dub, right? Like, oh, my cousin made this awesome mixtape. Then he made a copy for me, and then I'm going to make a copy for you, and then you make a copy for your friend. And there's a little bit loss of fidelity, and sometimes a substantial loss of fidelity each time you make a copy. And so I think sometimes firms that have, are in their eighth partner, multi-generations, I think sometimes firms, if they don't know what they stand for, they don't refresh their point of view, their take on the world. If they don't right size their team, their fund size, their economic distribution to match the current reality of what they want to be, they almost end up becoming like tape dubs, like a third generation bootleg of a great concert that got played 20 years ago. It's nostalgic. Everybody loves the band, but listening to it is kind of a shitty experience. And so the problem is, or the challenge is that, right, like fund cycles are long. Institutional LPs, for a number of reasons, are more likely to continue their relationship with a fund, even if it's less of an easy underwrite than it was initially or stuff. You want to give. So there's a lot of like perfectly fine reasons why it takes a long time. But like, I guess I think I'd like to see more funds shut down, reform, or resize based upon what they are today, versus sort of the notion that everything needs to be like this multi-generational, keep adding folks, keep handing it forward. So I wish the generational cycles were a little bit faster in venture and that Darwin was a little more aggressive.
Well, Hunter, this is a really fun conversation. I really appreciate it. I'd imagine there are plenty of founders out there who'd love to work with you. For any of them who are listening and haven't somehow connected with you before, what's the best way if a founder wants to get in touch for them to do
I
that?
am easily discoverable. I still like email. People can shoot me an email. Hunter@homebrew.co. Hunterwalk.com is my, I guess, almost approaching probably 20-year-old or so blog. It's the one dry piece of land on the internet that, no Twitter, no Substack. I mean, I like the idea that like I still own my own island in this weird World Wide Web thing. But you can find me most places. But drop me a note and I'll respond at least once.
Awesome. Well, thanks again for coming on the show.
Yeah, thanks so much for having me. I appreciate it. I'll look forward to your next guests, and now that I've had the experience myself.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.